In this video, we'll just explain a cash budget, and a forecast balance sheet and forecast profit and loss. We'll explain it using the SMASH example. the literature for that, the explanation of the business is obviously in the question sheet, from which we draw up a data bank for use with a spreadsheet. I won't explain the spreadsheet principles to you. It's just really where the figures go on the cash flow. Now you can see the data bank here. We've got an entrance fee of £5 with a maximum capacity of 2,000 people, and there's an occupancy percentage of 70%. So what that really means is on any one day, if we're charging £5, we'll get 70% of 2,000 people coming into the centre. Now that's 1,400 people per day, and then to get the number of people here per month, we multiply by the appropriate number of days in each month, so January 31, February 28, and so on, and that will give us the number of people coming in each month or buying tickets. Then we have to get our cash coming in. We've got sales of tickets, entrance sales, we've got food sales and beverage sales, and we can get those figures by multiplying up by the appropriate price. So for instance, on the entrance sales, that's ticket sales, we've got 43,400 people coming in, paying £5 each, so just multiply those two together and you've got the entrance sales figures. The food sales are slightly different. We've got a food percentage. We've got 40% of the people coming in, so 40% of 43,400 is the number of people who will buy food, and they will pay £8 each. So that will give you your calculation of food sales. Beverage sales, similar principle with your figures here. 30% of the people coming in paying £3 each. Okay, on to the money going out. Notice the cash flow, same normal layout. We've got money coming in and the total. We've got total money coming into the business, total money going out. And that's what really all we're trying to do. And then at the bottom, we want to show the balance. This is like your bank account, if you like. Cash flow means money in the bank. And we've got our closing balance at the end of each month. Obviously, we want to see if we're going to go overdrawn and things like that, which will help for our forecasting and planning. The money going out, we've got food cost. And food cost is simply 25% of the food sales in any one month. So 25% of the food sales, 25% of 138,000 gives us our food cost of 34,000 there. Beverage cost. Now beverage cost is slightly different. Beverage cost is 25%. Again, 25%, but it's 25% of the beverage sales, but it's 1 month in arrears, which means that we do 25% of the January beverage sales, but then we actually pay for it in February. So we buy it in January, we use it in January, but we don't pay for it until February. Cash flow, remember, shows when the money actually comes in or goes out in this case. So that 9,765, that figure there is the January purchases of beverage that we've not yet paid for. We paid for in February. But we've got to remember, with the profit and loss, that was used in January. Okay, now that's the important thing, and the beverage one is one where the errors are made. We put the other things in, wages, general, etc. Then we calculate our opening and closing balances. Now, there's a couple of things here that, because this is continuing business, we have to take notice of this balance sheet here. It's the balance sheet up until the beginning of the current year. So this is the balance sheet as at the end of December 2006. We're doing the cash flow for 2007, or the first 6 months. So one important point there, we've got in the bank, at the end of December, we had £80,000. That therefore becomes the opening balance in January, £80,000. Okay, so we've got to take some figures from here. We've got buildings and fixtures in here. Now that means we've already got them. We don't need to buy them again, so there's no money leaving here to buy fixtures and buildings. And also the same with capital. That capital's already in the business. We don't have to bother about putting it in again. So just be careful of that. You don't need to put that in again. It's already there. But what we have got, we've got money in the bank there. The other one that impacts on the cash flow is this creditors. You have to make a bit of an assumption here, but we assume we owe money to somebody there, a creditor, we owe money. The only thing that this business buys on credit, or what we've been told anyway, is for beverage. We buy our drink on credit, so we can presume we owed that at the end of December. We probably pay, it's a month's credit normally, so we're going to pay that in January. So we can assume that will be paid. So that creditor of 9,000 is paid for in January. So that's where that 9,000 comes from. If it was a new business, there wouldn't be anything there because there'd be nothing left over from December, and we'd had a month credit on the purchases that we made in January. Okay, so that gives you your cash flow. And you can total up here, getting totals for each row. One thing that you can put in there is this is like July, this column, and the figure there, 9450, that's the beverage cost. That's the June purchases that we won't yet have paid for, we'll be paying for in July. And we just put it there really for information for our profit calculation, because that has to go in our profit calculation because it was purchased and used in June, but we're not paying for it until July. So it's going to go in our profit calculation. And we also need it for the balance sheet because it will be the creditors on the balance sheet. On the new balance sheet, as at the end of June, we will owe that money. So there's your cash flow figure there, end of June, closing balance. That's how much we've got in the bank at the end of June. That again will go in our balance sheet. Just come across, look at our profit and loss account. We've got in the profit and loss account. Now I've done this in departments. You don't have to do this. You can just put totals in if you like, but I've just split it up into 7 departments. That, by the way, shouldn't be rooms. It should be on this one tickets or entrance fees there. So don't worry about that. That's tickets or entrance fees. So on here, the only difficult one, this is the sales of tickets, that's the sales of food, that's the sales of beverage, that's what they add up to. This is the purchases of food. We can get these straight from the cash flow. The only difficult one is that one, the cost of sales of beverage, the purchases of beverage that we made and used up in the 6 months. And if we just look on here, we just go across, we've got to look at these purchases of beverages. The 9,000, that was for last year. We purchased that in December of last year. That will have been in last year's profit calculation. The ones we want are from there through to the July, the payment that we won't make till July, but it's June's payment. That one's February, March, April, May, June. Sorry, that's January's. Sorry, January's purchase, February's, March, April, May, June. Those 6 add up. I've actually done a different calculation here in order to add those up differently. It's not the total of what's January to June, it's the total of the ones that matter for the profit and loss calculation. Okay, once you've done your profit and loss, don't forget you've got some depreciation in here, 4,000. It tells you 4,000 for the year. That's an expense on the profit and loss. Note it does not go into the cash flow. Depreciation is not a cash expense. It's just an estimate of depreciation. Our fixed assets there, I should have perhaps put these separately, and you can put them separately, but our fixed assets are our buildings and our fixtures, and we've taken 4,000, the depreciation for the 6 months, we've taken the 4,000 off the fixtures. That's why it adds up. So 800,000 plus 3,960. Okay, that's where we get that figure. Current assets, the bank, we've got that money. That's how much is left in the cash flow at the end of June. That's all what we expect to have. Our creditors are this new figure here, the beverage cost that we've not yet paid for, the June's purchases that we've not yet paid for. So that's the creditors. This is our new balance sheet. So it looks very similar to the balance sheet you were given for the end of the previous year, but you're just putting new figures in. the fixed assets have gone down a bit because of depreciation. The bank has changed because now we've done some more business. We've started with 80,000 and it's gone up to 204,000. 2,042,000 there. Net assets, fixed assets plus the current assets minus the liabilities. This bit here, the bottom, the financed by, or the capital part. The opening capital is what we started with in the original balance sheet. We had capital there, 1,271,000. We started with that, and we've added onto that the profit that we made in the period, 1,958,000. So we've added those two together. That gives us our total capital as at the end of the session that we're doing. This is the balance sheet up to the end, and you should put this in here, the end of June 2007. And notice, of course, these two should balance for you to be correct. Okay, try that one and see if you get the same answers out. And obviously this can also be put on a spreadsheet, would be a good idea, as is this one on the web page for you. Okay, thanks, bye.